The demand and supply curve is a fundamental concept in economics that helps us understand how prices are determined in a market. The demand curve shows the relationship between the price of a product or service and the quantity that consumers are willing and able to buy at that price. It typically slopes downwards from left to right, indicating that as the price of a good or service decreases, the quantity demanded by consumers increases, and vice versa. On the other hand, the supply curve shows the relationship between the price of a product or service and the quantity that producers are willing and able to supply at that price. It slopes upwards from left to right, indicating that as the price of a good or service increases, the quantity supplied by producers also increases, and vice versa. The point where the demand and supply curves intersect is known as the equilibrium point, where the quantity demanded equals the quantity supplied at a particular price. This equilibrium price and quantity are where the market clears, meaning there are no shortages or surpluses. Changes in factors such as consumer preferences, input prices, technology, or government policies can shift the demand or supply curve, leading to changes in the equilibrium price and quantity in a market. The demand and supply curve concept has various real-world applications across different sectors and industries. Here are a few examples. Pricing strategy. Companies use the demand and supply curve to determine the optimal pricing for their products or services. By understanding how changes in price affect the quantity demanded and supplied, businesses can set prices that maximize revenue or market share. Market analysis. Economists and market analysts use demand and supply curves to analyze market trends, forecast future demand, and assess market equilibrium. This helps businesses make informed decisions about production levels, inventory management, and expansion plans. Government policy. Policymakers use the demand and supply framework to design and evaluate economic policies such as taxes, subsidies, and price controls. For example, a government may impose a tax on a product to reduce its consumption or offer subsidies to encourage production. Investment decisions. Investors use demand and supply analysis to assess the potential profitability of investing in certain industries or commodities. Understanding market dynamics helps investors make strategic investment decisions. Labor market. The concept of demand and supply also applies to labor markets. Employers determine wages based on the demand for and supply of labor in a particular industry or occupation. Labor unions and policymakers use this information to negotiate wages and employment conditions. Overall, the demand and supply curve is a powerful tool that provides insights into market behavior, helps in decision-making, and enables stakeholders to understand and respond to economic changes effectively.